Okay, you're back with Gold Seek Radio. My next guest, Harry S. Dent, the head of the H.S. Dent Corporation, an economic research and forecasting company well known for market trend analysis and forecasts. Welcome back to the show, Harry.
Nice to be back.
Many of the top financial and economic guests I talk with they're in the same boat as myself. They've sold their debt shacks and they're currently renting a house. Last time we spoke, you mentioned that you were still renting. Did the May uptick in housing prices change your views at all here?
No, in our book that came out late last year and in December 2008, we said, even before a lot of this happened, that we were going to see a first downturn. It was going to be a deep recession, not a depression. The government was going to stimulate strongly. That's a predictable thing in these times. And that we would start to see a recovery, but it wouldn't be a real recovery. Baby boomers are way past their peak in spending on housing. That's the first thing to peak in a bubble boom like this. And they're going to start saving more, continue to save more than spend. They've been scared to death that their retirement savings are not going to be enough now. They really weren't enough in the first place. And with a declining economy and all assets falling and their investments falling, they're not going to go back into spending mode more than a cash for clunkers thing or something like that. They're certainly not going to go back into a major house buying mode. So we were predicting there'd be a bounce in the stock markets in the summer, that real estate would see a mild rebound, but that we would go back into a deeper downturn between late 2009 and late 2010, and that downturn would probably be at its worst for the economy and unemployment in early to mid 2011. So that we're right on track pretty much with our forecast. This is what we call the eye of the storm. After the first part of the storm hits, the eye comes over and everything seems to be okay for a while, and then the second part of the storm hits, and of course the second part of the storm is always worse.
Keeping with your hurricane analogy, current records here showing about 27% of the domestic homeowners who hold mortgages are now underwater. And as that typhoon approaches the shore, this number is expected to skyrocket. If we can believe Deutsche Bank, incidentally, have been right on the money all the way through this housing crisis. Deutsche Bank's analysts claim that up to 50% of this nation's mortgage or debt holders will find themselves upside down and underwater before 2011. So if that's the case, then we're going to see foreclosures and defaults continue to mount, and we will obviously see an inventory glut. At some point, that has to put further downward pressure on this market.
It does, on the economy, the stock markets, housing, everything. This is exactly what we've been saying, is that if this was an ordinary recession, believe me right now, the paradox is leading indicators, which we study heavily, and we study the best ones from ECRI. They're saying we're going to have a full-fledged recovery, and it's just not going to be true because they're looking at money supply, and the government has stimulated money supply to an unprecedented degree, but they're not looking at monetary velocity. Banks aren't lending, consumers aren't spending. All this minor turnaround we're seeing here is from government spending. And what we're saying is consumers are not going to follow through the government spending. Normally they would. You stimulate the economy, people turn around and spend the money. But baby boomers have aged past their peak in spending. This is something we were predicting 20 years ago towards the end of this decade. This massive generation would peak in their spending. They would become savers instead of spenders. That would cause a long-term downturn. And, of course, housing would peak even before that and go into a long-term downturn. So this stimulus is not going to work past the point, and the leading indicators are probably basically going to be wrong. We're going to continue to see some positive signs, but I don't even think it's going to be that long before people realize, the consumer is not coming back. The banks have been mended enough just to not fail and to get back towards even, but they're never going to be lending like they did in the last decade before we hit this wall and real estate declines. So yes, this is a broader downturn. It's the deleveraging. The most important thing to understand here, it's the deleveraging of the greatest credit bubble in modern history and the greatest real estate boom and bubble in modern history. We had a similar thing in the roaring 20s in the United States, into the 30s and the 80s, into the 90s with Japan. But this is a concerted worldwide bubble and bust. It's happening everywhere. And so people really need to say, look, you've been thinking of selling real estate and wish you had. Hey, it's lightening up a little here. Go ahead and sell that condo you didn't sell or that investment real estate that you thought would go up forever. If you got caught in the downside in stocks, well, they bounced a lot, and we're probably near the peak. We've been saying for a long time, somewhere between about 9,100 and 10,300, this bear market rally is going to peak. And it's looking like it may have even peaked here just recently, a little under 9,500. So you got to get liquid, you got to protect your assets, and the advantage of that, it sounds like horrible. Oh, I can't make any money, I'm sitting in cash. It's wonderful for somebody who does that because real estate's going to fall further, stock's going to fall further, businesses you're going to be able to buy and assets for nothing. This is the greatest sale of a lifetime in financial assets, but if you don't have cash flow, and credit, you're not going to be able to take advantage of it, and nobody's going to lend you money.
Backing up to your deleveraging scenario, this is the topic du jour. Surprisingly to me, many of the mainstream economists have missed, and they continue to miss, this inflation-deflation debate completely changes when we add in that magic term deleveraging, because it's the credit side of the equation, if you will, consumer price index, that so many folks are ignoring here. As you pointed out, the service that you follow continues to promote the concept. These green shoots will turn into wonderful beanstalks. And we forget that for 20, maybe even 30 years, credit flowed like wine. And that has not only stopped, it's reversed course, and it changes the whole landscape.
It does, and there's mistakes on both sides. You get the bearish economists who say, oh, the government's gotten too much debt, and private citizens and business have got too much in debt, and now the government's going to stimulate its way out of it with inflation, and it's going to cause massive inflation. Wrong. Rise in government debt and stimulus is not even coming close to the decline in consumer and household assets and the deleveraging of private credit. And what you said earlier is the secret. Everybody's looking at money supply, and in most cases, okay, when the economy's down, the government stimulates, increases the money supply, and everything follows. But when private credit goes to an extreme and bubbles up and saturates businesses and consumers and starts to deleverage, it's what economists should be looking at is the deleveraging of private credit. It is happening faster than government debt. It's happening faster than stimulus, and that's what leads to deflation. So we even disagree with most of the bearish people who say, oh, this is a crisis, government stimulates out, we end up with runaway inflation. No, we end up with deflation.
How could we have inflation against this backdrop of a crushed bond market, not to mention your point that money is being flooded into the economy? But look at interest rates. Under typical economy, when you pull interest rates down, for all intents and purposes, zero, you wouldn't just see a dead cat bounce in the stock market. We'd be looking at 20, 30, 40,000 Dow Jones.
Yeah. We'd be looking at new highs almost already. And the market's already stalling here in August. So no, it's true. And the other thing we tell people is you almost don't have to debate this. We have the incredible luxury of having Japan already have gone through this crisis in a much more benign environment. The rest of the world didn't turn down. Only their demographics and baby boom turned down. They had their big housing bubble with their generation in the 80s. It was just as extreme as ours, in fact, a little more, and it all crashed down. And despite 100% of GDP, which is massive, and stimulus over time, and in the rest of the world booming and their export industry still booming, Japan's stock market still went down 80% in the 90s and early 2000s, and housing went down 63%, and their banks just continued to fail. Now, the problem is that unlike the 30s, which was the big criticism in the United States, the government didn't have this Keynesian thing of, oh, well, the government's got to offset the private downturn and rack up debt and stimulus. We didn't do that in the 30s, and you know what? We eliminated tons of debt, brought down real estate and interest rates, and it caused the greatest mass prosperity boom in history. It was a good thing. Once you get too much in debt, in a credit bubble, in a housing bubble of this magnitude happens, the only path is to deleverage. Otherwise, you stay out of balance and can never grow again. New generations could never buy houses at the prices in California and New York and Miami and stuff in the future with the way things were going. And we could never handle all this debt. The problem is Japan's government did largely offset the deleveraging of private sector debt with government debt. Now they're stuck with an aging generation, an aging population in Japan, the most aging in the world, and the highest public debt ratios in the developed world. Japan, they're going nowhere, and they've gone nowhere since their peak. And so it proves a couple things. Government cannot prevent a deleveraging of a bubble this big, or can they stop the natural demographic slide of a large generation moving from their high-spending 30s and 40s into their savings and retiring 50s and 60s? It's a natural cycle. Baby boomers are going to spend less no matter how much stimulus the government puts in the economy, and therefore the stimulus just turns into debt that future generations of people have to pay.